What is up, everyone? I hope you're all having an incredible morning. I am personally buzzing today because I'm off all next week, finally taking a little vacation to recharge. But before I head out, we need to have a serious talk about the reality of the markets. What if I told you that price discovery is a myth? What if the chaos, the red and green candles, and the volatility you see on your screen every single day is nothing more than a carefully orchestrated smokescreen? What if the real decisions, the actual prices of the assets you hold, have already been signed, sealed, and delivered in closed rooms, behind NDAs, and far away from the prying eyes of retail? Today's story sounds like a conspiracy until you start connecting the dots. And once you see the pattern, you can't unsee it. Grab those tinfoil hats, folks, because we are going deep down the rabbit hole. If you appreciate the deep dives, make sure you're subscribed to the channel and hit that thumbs up. It's the ultimate way to support the show, and it's completely free. Now let's jump right into the deep end. Before we dissect the price set theory, I have to tell you about the XRP Insiders Elite. You get exclusive market deep dives, strategies, and the exact insights I use to stay ahead of the curve. If you're tired of being exit liquidity and want to trade like an insider, this is your seat at the table. It is the most powerful tool in your arsenal to navigate this transition. Check the link in the video description to join us today. Now look at what's happening on your screen right now. The US House is currently drafting a bill to exempt stablecoin transactions under $200 from capital gains taxes. On the surface, it's a boring piece of legislation. It's a low amount, right? But look at the subtext. This is pure behavioral engineering. They're literally lining up the rails for crypto to be used for everyday life, groceries, gas, coffee. You don't remove tax friction unless you are preparing for massive sustained volume. This isn't about speculation anymore. It's about infrastructure. They're prepping the cashier lines because the store is finally about to open. But while the lawmakers are busy smoothing out the tax code for your daily spending, something much more interesting is happening with the assets that are supposed to move the big money. We've seen Bitcoin maturing with its ETFs and Wall Street's embrace. But have you noticed how the real plumbing tokens, the ones meant for institutional settlement, always seem to stay suppressed? Credible Crypto recently pointed out that the idea of diminishing returns for Bitcoin is playing out perfectly. Every cycle, the upside is less and it takes longer to get there. It feels like Bitcoin is being used as a pressure valve for retail energy while the real work happens backstage. The narrative is shifting. We are moving away from what will the price be to what has the price been set at. The Black Swan theory suggests that XRP's price isn't being discovered. It's been predetermined. The claim is that XRP underwent a pre-IPO phase ago, where banks, funds, and global institutions negotiated a fixed value behind closed doors before retail even entered the chat. While there's no smoking gun document, this is exactly how the traditional financial world operates. IPO prices aren't found on an app. They are agreed upon in private boardrooms. The public market is just a liquidity sponge, a place for the disbelief phase to play out until the switch is flipped. And if you look at how commodities like gold, oil, and wheat are priced, they aren't set at the shop or the pump. They are set in the derivatives markets. Derivatives create the expectation anchors the behavior, and the behavior shapes the price. If institutions want the stability required to move trillions of dollars, they cannot and will not rely on the chaos of the spot market. They need a permission to price. This leads us to the most provocative theory in the space, that assets like XRP and XLM aren't actually investments in the traditional sense. They are instruments. And instruments don't moon based on hype. They activate based on mathematical necessity. For cross-border payments to function, you cannot have 20% swings because of a meme or a tweet. You need a set fiat value to enable seamless instant transfers. Banks don't hedge on hope. They hedge on certainty. If XRP is the bridge asset it's designed to be, it doesn't need retail's permission to rise. It needs the system's permission to snap into place. When the plumbing is finished and the derivatives market is mature enough to anchor the value, the price won't climb a ladder. It will simply be set to whatever level makes the global math work. We are watching the architecture of a new financial system being built in real time. And while the world watches the noise of the charts, the real signal is being whispered in the rooms you aren't invited to. Stay sharp, stay curious, and remember, the plan is usually hidden in plain sight. This brings us to the actual mechanics of how a price might be set without a single headline ever announcing it to the public. You have to understand that in the world of high finance, the spot price, the one you see on Coinbase or Binance, is essentially the tail of the dog. The dog itself is the derivatives market. In 2025, the maturation of crypto derivatives has reached a tipping point where they no longer just track the price. They dictate it. When you have massive futures, options, and swap markets, you create a gravitational pull that the spot price eventually has to follow. Think about it. If the world's largest liquidity providers and market makers agree on a valuation within the derivatives complex, they can use hedging and arbitrage to pin the spot price to that specific level. It's not a peg in the way a stable coin works. It's a consensus-driven anchor. This is precisely why the recent bipartisan legislation from Congressman Max Miller and Stephen Horford is so significant. By drafting de minimis rules that exempt transactions under $200 from capital gains taxes, they are removing the final friction for mass velocity. But more importantly, the bill specifically targets regulated payment stablecoins and digital assets used for everyday payments. Why does this matter for XRP and XLM? Because you cannot have a global payment rail where every 3-second settlement triggers a taxable event for the intermediary. By smoothing out the tax code, they are effectively clearing the brush for institutional plumbing to operate at scale. They aren't doing this so you can buy a $5 latte with Bitcoin. They are doing it so that trillions of dollars can flow through these protocols without getting snagged on a 1980s era tax framework. Now let's look at the pre-IPO theory through a more clinical lens. If you were a central bank or a massive institution like JP Morgan or BlackRock, would you ever step into a market where the price is determined by retail sentiment and moon tweets? Of course not. You would demand a seat at the table to negotiate the entry price. This is exactly what Versara and other analysts have been pointing toward. The theory suggests that the price discovery for XRP didn't happen on an exchange in 2017. It happened years ago in the boardrooms of the BIS and the IMF. They needed a price that was high enough to handle global liquidity, but stable enough to prevent systemic shocks. If XRP is intended to move 194 trillion in cross-per value, a market that is forecasted to hit 320 trillion by 2032, the math simply doesn't work at $200. To move trillions without slipping the price, the asset needs deep concentrated liquidity at a much higher valuation. This is where the activation versus investment argument becomes undeniable. In a world of ISO 2022 standards, which remember becomes the absolute global mandate in November 2025, data is the new gold. The transition from the old Swift MT messaging to the new ISO standard is essentially the software update for the entire financial world. This update allows for rich data to be attached to every payment, and XRP was built from the ground up to be the native bridge for this exact data-heavy environment. If the world's banks are moving to a unified standard, they need a unified bridge, and you don't build a bridge out of wood. If you're planning to drive 10,000-ton tanks across it, you build it out of reinforced steel. The set price theory argues that the steel in this analogy is a predetermined valuation that provides the necessary collateral base for global debt settlement. Look at the silence from the major players. Ripple has spent years fighting the SEC, not just for a win, but for a specific regulatory classification that allows them to apply for things like an OC National Trust Bank charter. Why would a crypto company want to be a national bank? Because banks have the power to set value through their balance sheets. When the SEC finally pivoted toward Project Crypto earlier this year, it wasn't a surrender, it was an integration. They're overhauling securities laws to enable America's financial markets to move on chain. This isn't a theory anymore. It's a documented government initiative. They are building a system where value is established by the protocol, not the shopkeeper. When you see the derivatives market exploding, now representing over 70% of all crypto trading volume, you are seeing the institutional ballast being loaded onto the ship. They are preparing to steady the vessel. The volatility we see today is the last gasp of an inefficient retail-driven market. As we move into 2026, the transition from speculative asset to functional instrument will be complete. The price won't need a pump because it will be supported by the sheer weight of the global economy moving across its rails. We are talking about a snap-to-grid moment. One day the liquidity will be turned on, and the math of the global financial system will require the price to be at a specific level to maintain equilibrium. It's not about if it goes up, it's about when the system decides it's time for the asset to perform its intended function. This is the end game of the plumbing tokens and the window for retail to front or run. The institutions is closing faster than most people realize. This is not financial advice. So what is the final trigger? We've talked about the closed door negotiations, the shift in tax laws, and the derivatives market acting as the ultimate anchor. But the true snap-to-grid moment happens when the utility is actually turned on at a global scale. In the financial world, we call this the activation of the bridge. Think about the ISO 2022 mandate that officially became the global standard on November 26, 2025. This wasn't just a technical update for banks. It was the moment the world's financial languages became unified. When every bank is speaking the same language, they need a universal translator to move value instantly. This is where XRP and XLM stop being speculative coins on an exchange and start being the actual liquid fuel for the world's machinery. You see, for a bridge asset to function, it must have enough value to carry the load. If a bank needs to move $1 billion across the ocean in 3 seconds using XRP, they can't do it if the entire liquid supply of XRP at the current price is only worth a fraction of that transaction. It would cause a massive price spike or slippage, making the transaction impossible. To settle the trillions of dollars that move daily through the correspondent banking system, the price of the bridge asset must be high enough mathematically to absorb that volume without breaking the market. This is why the set price theory isn't just a fantasy. It's a liquidity requirement. The price doesn't go up because people are excited. The price is adjusted because the system requires it to be at a certain level to function as a global reserve and settlement instrument. The most incredible part of this entire transition is how quiet it has been. While retail investors have been distracted by the crypto winter of late 2025 and the massive $1.2 trillion market flush we saw just 6 weeks ago, the institutional plumbing has been finalized. We've seen Ripple resolve its final disputes, the SEC pivot toward an on-chain integration of US markets, and the derivatives market grow to 10 times the size of the spot market. This is the ballast I was talking about. They have stabilized the ship so that when the switch is flipped, the price doesn't moon and then crash. It moves to its utility value and stays there. This is the assigned value phase. Imagine waking up and seeing the market has fundamentally changed overnight because the central banks have officially plugged into the XRPL and Stellar networks. At that point, the chaos we see today will look like a tiny blip in history. We are moving toward a world where value moves as fast as information, and you are currently holding the keys to the most important infrastructure in human history. The store is opening, the rails are laid, and the set price is the final piece of the puzzle. Don't let the noise of the day-to-day candles blind you to the massive structural shift happening beneath your feet. The transition isn't coming. It's already here. If you're ready to stop guessing and start following the institutional blueprint, you need to be in the XRP Insiders Elite. This is where we break down the high-level moves and exact strategies to position yourself for the great reset. Don't get left behind in the old system. Join the Elite today via the link in the video description.